In this video, we consider a particular aspect of IFRS 15 revenue from contracts with customers. The aspect we're considering is the significant financing component contained in a transaction that results in revenue recognition. IFRS 15 paragraph 60 states that this must be taken into account when the financing provides significant benefit to the customer or the entity. This may imply that there may be a financing element involved when the payment occurs post-delivery, after the delivery, or in fact there may be a financing element where payment is received in advance, preceding the delivery of the goods. To explain this further, let's consider an example. On 1 July 2014, A Limited received a payment of $900,000. In terms of the contract, A Limited would only deliver the product on 31 December 2014. Remembering that IFRS 15 recognizes revenue now when control of an asset is transferred, it appears as if the revenue would be recognized on 31 December 2014, the regular cash selling price being $900,000. Given that payment has now been received in advance of the delivery and transfer of control, a financing element may be at hand. It is acknowledged that IFRS 15 says that the period less than a year may be immaterial and ignored. However, just for purposes of this example, we ignore that exclusion for now. Having a look at the resulting journal entries. When the payment is received by the seller in July, the $900,000 is debited to the bank account, with a contract liability being created on the credit side. In December, we are now able to recognize revenue when control of the asset is transferred. However, in the interim period, we have had this money and there is a financing cost involved, which is calculated at an interest rate over a period of time. What appears to cause some confusion is that the revenue is effectively increased from the cash flow of $900,000 to $954,000, with the increase being the finance costs of $54,000. Some therefore argue that it does not make sense that a finance cost is debited and revenue credited. To explain that, let's split this economic event into its two components, and also make it from two separate stakeholders. First of all, the entity has the contract with the customer and needs to deliver the goods to them in December, with the sale being recognized in December. The $954,000 being credited to revenue, with the debit to bank, if this is a separate client. The entity may, however, need cash flow in advance to generate and produce this product. They may approach a financial institution, for example, for a loan. The 900,000 Rand would be received in July with that journal entry. As a result of this being a financing transaction, money lent from a bank or third party, there would be finance costs at play. At the end of the financing period, when the entity has now received the money from the customer for the goods sold, they can repay the loan to the financial institution. What happens in the previous slide is that this final cash flow, because it is with one party, would not occur, so the bank transaction there would be eliminated. Thus, it appears as if the finance cost of $54,000 is debited and revenue credited. However, remember that it is two separate economic events. The first separate economic event being the financing, and the second one being the sale. And it is only coincidental, so to speak, that these transactions have happened with one particular person, and not two separate entities, which makes more sense. Just to recap then those journals again. You receive your money from your client at $900,000. You only deliver those goods and recognize the revenue with the passing of control in December. In the interim period, because of the financing element, you need to have the finance costs. The repayment, so to speak, of this loan and the payment from the client effectively netting off as it is one entity.